Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Are you ready to get started? Let's go.
Welcome everyone to another Retirement Roadmap podcast, brought to you as always by SHP Financial. I'm Derek Gregoire, joined by one of our lead planners here, Alina Osokhovska. Did I get that right?
You did.
She's been working this for a while, but I just don't, it's a tough name to pronounce, I'm not gonna lie. But welcome to the show.
Thank you. Hi everyone.
Yeah, we are excited about this show because this is dedicated to a lot of folks out there in terms of what we're gonna be talking about, but specifically in terms of like high net worth investors. So if you save more than 1 to 2 million in your portfolio, what we've seen since we opened the doors back in 2003, right, in between Plymouth and Woburn and Hyannis, right, we've seen so many times when folks come into our firm for the first visit, and clients that are listening now that know this, when they first come in, they have just a portfolio, which we know is very important, but there's a huge difference between a portfolio and a full plan, right?
Absolutely. And
as we record this right now, we're actually going through some market volatility. Here we are in mid to early 2025. And so this timing couldn't be better for this type of topic. So as you listen to this show and some of the topics we discuss, I really want you to pay attention to make sure, are you getting this type of planning, right? Because I'm looking at a recent client we took on. They had about 5 to 6 million in portfolio assets. And I have 9 pages of notes from Alina and her team of planning opportunities, right? And so all I can say is none of these notes, there's very few of these notes are around the portfolio because we have a separate team of CFAs and analysts that manage our clients' portfolios and do a great job at it, especially with this volatility happening. But this is beyond that. So we're assuming, and I hope this might be a bad assumption, we're assuming that everyone listening has a good portfolio with proper risk tolerance that are not getting, if you're close to retirement, you shouldn't be feeling the pain of this market as much as the market's going down. So we're assuming that's the case. Now, again, I know it's a big assumption, but let's say you have a strong portfolio and that's going on. Alina, we know there's so much more to it than that. And
absolutely.
So we're gonna get into areas such as, our 5 areas we look at are income planning, investments, taxes, healthcare, and estate planning. I think today we're going to focus a little bit. Cash flow we're going to get to cash flow a little bit because in terms of, I guess we'll start there. So when we're looking at taking on a client, right, obviously if they're getting ready to or in retirement, their main thing they want to start with, think of the foundation of a plan or a roadmap is, do I have enough, right? That's the first thing. So take us through the steps of like, just when it comes to creating a cash flow, like where do we pull from? How do we set the accounts up? That's the first process we want to make sure it's taken care of.
Yes, that's a really good question. And it is connected to the tax planning as well, because we want to make sure that it is tax efficient. So they do not overpay in taxes. The cash flow doesn't put them in the high tax bracket and also impact their Medicare premiums.
Exactly.
So we take a look at their total portfolio, different buckets, like taxable bucket, can be brokerage account, cash account, also retirement assets like an IRA, SEP, simple, 401k, 403b, different plans. And perhaps they have a Roth account as well. Hopefully, right? And then we take a look at all their assets. We take a look at their income needs in retirement, and we try to develop a plan that works for them.
And then one of the things we do here, I'm looking at page 20 of your 25th page, looking at the notes here, we also, for this particular client that we just built out this plan for, we looked at different ways to take Social Security. So yes. In one instance, like by taking it at a certain age versus full retirement age, which is 67 for them versus 70, the break-even point on paper might be like 78, but when you plug it into their plan, the break-even point could be like 90. So sometimes taking it at full or a little bit early might make sense based on the plan. But then also, like Alina said, it's really about what buckets do we pull from and when? Well, some of that depends on where the market is. So you want to make sure we have those like safety, income, and growth, meaning assets are set aside for the proper withdrawals that you need. And then the long-term bucket is growth that you don't necessarily need from. So it's all about the risk factor of each account that you have, the tax factor, what the tax ramifications and Medicare ramifications are of your withdrawals. And so that's like step one, right? Just having an income plan so that you, if you're married, your spouse, you're going to be okay. That's step number one. That's the foundation of any plan, right? Well, that's like the foundation of a house, but what do we do to protect that foundation? And what's that foundation designed to do? Well, we have to build a wall and windows and roof. And so now we have to look at what are threats to that income? What are threats to their portfolio? And I think the first thing we look at is taxes.
Taxes and also their investments, right?
Exactly. Yeah. Investments, as we talk about volatility, and then taxes. So let's look at some of the ways. So we had, again, looking at a recent client that came on. It was either from radio or TV, I forget which one, but they had worked hard, saved up over $5 million, and they basically wanted to be more tax efficient. So if we can just take, and someone listening, if you're a high net worth investor of over, call it 1 to 2 million of investable assets, what are some of the things they should be thinking about in their plans?
So first of all, I would recommend to take a look at some fixed income in retirement, right? Because some people can have pensions. To your point, some people qualify for Social Security, depending on when they want to retire. Some people retire at 65 or 67. Also, a good consideration will be health insurance in retirement, because if you want to retire early and you have means, that's amazing. But also, you need to think about how you're going to pay for your health insurance before Medicare kicks in. So that also, it's a good tax planning technique, as well as pulling from different buckets. And at age 63, that's when the taxable income considered for Medicare premiums, because every year it is evaluated for the next 2 years.
Yeah, so if your income this year determines your Medicare Part B premiums 2 years from now.
Yes, correct. So, for example, for the client that we're discussing, we took a look at their fixed income, kind of like, they have a pension. Let's take a look at their Social Security. Does it make sense for one of the spouses to maybe claim benefits right now and then transition to the spousal benefit at later age? And for the spouse with a higher Social Security benefit, maybe it makes sense to delay and take advantage of that growth that Social Security offers. Also, we look at, let's say, taxable accounts, and when we make withdrawals from those accounts, the tax implications are different, right? Because then they're going to realize either long-term or short-term gain and dividends, qualified or non-qualified dividends. And if they take money from retirement sources like pre-tax IRA, it will be taxed at their ordinary tax rates.
I just want to pause right there. Think about that. So most of the folks that, including this client, and I won't get into the details, but the majority of folks listening have the majority of their assets in pre-tax, 403B, 401k, IRA, right? And they think, I have plenty saved. I have $1 million, $2 million bucks, but sometimes they don't. A lot of people never know the tax ramifications. Like if you ask someone how much they have in their IRA, they can probably tell you just off the top of their head. If you ask someone, what are the taxes you'll pay on that in your lifetime? Very few can give you that answer. And so that's what Alina has been saying is like the different amount of taxes that we have to look at. Like if it's a brokerage after tax account, you look at long-term capital gains, short-term capital gains, dividends, so they qualified or non-qualified, interest, right? If it's a pre-tax account, we're looking at ordinary income. So not only is that taxed at your highest bracket, it also, that adds to your future income when it comes to how much your Medicare Part B costs. And the list goes on and on. So planning is a lot more than just like, it's a couple things. It's like, if you don't do one thing right, it could impact 3 other areas of your plan. Absolutely.
Also Social Security benefits, right?
Yeah.
Because higher is your taxable income, then at a higher rate, your Social Security benefits can be taxed at the highest 85% of the benefits can be taxed, right?
Yep.
So Sometimes it makes sense for some people to take money from their pre-tax accounts at a smaller portions just to spread out that tax liability over some years.
Yeah.
And then combine it with taking money from their taxable accounts, like brokerage accounts
Correct.
or cash accounts, Social Security benefits or pension.
Yeah. And also too, if you like, so when sometimes a lot of our clients, they might take a certain amount out of their pre-tax accounts to get to a certain bracket, but then maybe they take the rest from after tax or Roth, so it doesn't push them into a higher tax bracket or higher Medicare premiums. So I'll pause for a second there. If you're listening, right, and you're saying, oh my gosh, I've never even heard of these things, or I haven't done these things, and I've worked hard, saved up a lot of money. You don't want to be that person who's worked up, saved up money, has enough to retire, and either A, takes on too much risk, or B, has no tax efficiency, because tax codes changing is almost as risky, if not more, than the market changing. If tax codes go up, if tax rates go up, that means you have less when you pull out, which is like losing money in the market every year. So at SHP, obviously, we can't work with everyone, but if you've saved $1 million or more in your investable assets, we have set a few times aside in one of our offices. You can come in for a second opinion. There's no cost to do so. All you have to do is call 508-746-2400. Again, 508-746-2400. Or you can book a visit right online at shpfinancial.com. Again, shpfinancial.com. Like I said, people have worked too hard and too long to be not dotting all their I's and crossing all their T's. So highly recommend, if you're in that boat, you saved up more than $1 million, give us a call. We're happy to walk you through that initial consultation. So, all right, back to the planning board, Alina. So in that scenario, right, we looked at, for them, we looked at another window of Roth conversions, and
Yes.
just maybe explain the Roth conversion process and how it works.
Absolutely. So there are two different ways you can contribute to a retirement account. On a pre-tax basis, then you take a deduction of the year of the contribution, or after-tax basis. So if you don't get the deduction and you put money, let's say, in a Roth account, Roth IRA, Roth 401k, Roth 403b, and that money grows tax-free.
Yeah.
Until you can take money out at your retirement age. So when you have, in your, let's say, higher income years, you can take advantage of pre-tax contributions, because then you get a deduction, you pay less taxes. But then you have to think about future tax ramifications of your distributions. There is a great tool called Roth conversion that you can utilize to convert those pre-tax assets into Roth accounts. So you pay tax at the time of the conversion, but then the assets in that Roth account grow tax-free.
Perfect. Yeah, and that's something that you definitely do not want to do without doing, like, so when our clients do this, we A, look at their tax returns.
Absolutely.
We B, analyze their tax brackets, and then make recommendations year by year to make sure we're getting the most, being as efficient as possible with taxes within your plan, because tax diversification is huge. And everyone thinks about diversification in the market, but having diversification between pre-tax, after-tax, and no tax, which is tax-free, the Roth, is important. And the problem is, if all your money is in pre-tax 401k and you haven't done any planning, we have to pull out of those buckets when you retire. And it just depends on where the tax rates are. And we have no say. There's no flexibility because everything's in that bucket. So a lot of times in these windows of doing conversions, a lot of times you can add tens, if not hundreds of thousands of dollars to their plan by proactive tax planning.
Absolutely. And when we move assets from a pre-tax account to Roth account, that we can be a little bit more aggressive than account, because
Yes.
we will not have to pay taxes on the growth. And that, I think that's amazing.
Yeah. So that growth of your Roth is tax-free both now, right? So anytime, let's say you had to pull $50,000 out of your IRA, well, you might have to take out 80 just to keep 50, because state and federal taxes are held. If you need 50 out of a Roth, you just pull 50 because there's no taxes that have to be paid. So, and then secondly, if you look at the opportunity that we're in right now in terms of proactive planning, again, maybe not, we don't know when this is going to air, but right now the market's has some serious volatility. And the joke always, when someone signs on as a client, they said, do we still pay you when the market goes down? I said, you probably should be paying more. Because number one, that's when we do our best work, because the planning tools that are available during market downturns, I won't get into all of them right now. Well, I can tease a couple, like tax loss harvesting, shifting some money from conservative to more aggressive over dollar cost averaging back into more aggressive, but then also Roth conversions. Think about it. If you can convert, we did a ton of this back in 2020 during COVID, we did a ton of Roth conversions, which means we moved money from pre-tax to tax-free, right? We paid the taxes, but guess what? When the market recovers, that you're getting that recovery in a tax-free account that's never taxed again. So think of the long-term impacts of those simple moves around Roth conversions. So in a lot of the tools that we use, when it shows the positive gain for our clients over the long run by doing some tax work, it doesn't even consider the fact if we do it around market events like this. You know what I mean? So Roth conversions, obviously, we have to find the right window to do it, the right tax brackets to do it. It's not for everyone, but Roth conversions are a huge, huge, huge benefit to the type of planning that you should be looking at if you don't have it in your plan. So again, we mentioned this a little bit earlier. We have offices right in Plymouth, Hyannis, and Woburn. If you're listening and you say, you know what, I'm concerned about the market, I'm concerned about this taxes, I never looked at things like this, we're happy to do a no-cost review with one of our advisors here. Simple. It's very simple. Call our office, 508-746-2400. Again, 508-746-2400. Or simply go to our website. There's a ton of good information and content there. And you can also book a visit there at shpfinancial.com. That's shpfinancial.com. All right, so Alina, we're not going to get to all this, by the way, but we've talked about so far just setting yourself up cash flow wise. Where does the money come from? Basically, the question clients want to know when it comes to cash flow is, are we going to be okay? Do we have enough? Are we going to be okay? We've settled that here today. We have that. Obviously, you want to build that plan first. Now we're looking at threats to that cash flow. And one of the huge threats is taxes. And we've looked at a couple different ways to maybe plan for taxes in the future. Another concern of a lot of high net worth clients and investors is around estate planning, right? And so what I didn't even, before I get to that point, the other benefit too of having a Roth that I didn't mention, if you're, not that everyone's concern is leaving money behind, it should be more about you than anyone else. But assuming you have enough and you get by, let's say you and your spouse, right, want to leave some money to your children. If you leave it in a pre-tax IRA, they have 10 years where it all has to come out and it's all taxed at the ordinary income. And it's crazy how the government set that up, right? You figure, because they know when the baby boomers pass away in their 80s and 90s, their children are going to be in their 50s and high income bracket earners, and you don't want to wait 10 years to pull it out because you're going to get nailed all at once. And if you take it out even a little bit at a time, that's fully taxable to them. By converting to a Roth or having Roth IRA assets, let's say you pass away at 95 years old, right? Playing golf, whatever it is. And now your heirs, your children can wait 10 more years of tax-free growth before they have to cash out tax-free. So I think the long-term planning opportunities around that are huge if it works in your situation. So separate from that, there's a lot of other estate planning techniques that we use. Some around gifting, some around just estate planning in general. So if you want to kind of tease a few of those areas, what are some things around gifting and estate planning we do for our clients, high net worth clients?
Yeah. So first of all, I always ask our clients or prospects whether they have any estate plan in place, right? Whether they have any estate planning documents. And that is very important because we don't want to think about something bad happening to us, but it's life and it's better to be prepared and take care of your family, of your kids, and also your assets.
Yeah.
To make sure that the wealth that you worked so hard for is transferred to the people you choose tax efficiently, right? So just taking a look at the estate planning documents, there are some basic estate planning documents for people to have. I'm just going to mention them.
Yeah, sure.
Quickly, it's a durable power of attorney, healthcare proxy, HIPAA authorization, living will, and there are more complex documents like various trusts. I'm not going to get into every single of them, but if you don't have any documents, this is a great starting point just to get some of them done. Then here at SHP, we take a look at the existing documents as well, just to make sure that everything is up to date. For example, a durable power of attorney has to be renewed every 3 to 5 years, just not to be considered stale when you go to a financial institution and let's say a bank, they have their own regulations. They can say, oh, it's too old, we're not going to accept it. That's not what you want to have. In regards to tax efficient transfers, gifts, you can max out your annual gift tax exemption. As of right now, it is $18,000.
Maybe 19.
19.
It's somewhere between 18 and 20, but that's you can
19. You're right. It is 19 for 2025.
See, once in a while I get one right.
So you can utilize that to transfer funds to tax-free. Basically, you don't have to file a tax return to do that. If you're charitably inclined, you can also do QCDs, qualified charitable distributions, from your retirement accounts when you turn 70 and a half. You can also consider donor advised funds, so you can fund it with a highly appreciated security, and then you can donate from that fund every year. And you take a deduction for that gift. So
that's a lot of you just gave a lot of awesome information. So I just want to break it down a little bit in terms of like first, and why do clients sometimes gift? You can give $19,000 per person per whoever. So if you're married, you can give $38,000 per year to whoever. And what that does is it reduces your overall estate, because Massachusetts, once you have over $2 million, it's taxable. Your estate is taxable at an extra convenient tax that you get when you have over $2 million. If you're married, you can do some trust planning and potentially get that to $4 million. But again, that's why certain folks gift around different strategies around donations, right? So we always say to our clients, if you're already donating money, right? A lot of our clients are charitably inclined, and they're giving a lot of money away. But sometimes they were giving from money they had already paid taxes on, right? So you get money in your bank account, that money you've already paid taxes on, and then you give 10, 20,000 or whatever to a charity. That's awesome. That charity gets that. But if you use a QCD at 70 or older, you're taking that, you're doing the same thing, but you're giving it from pre-tax money. So instead of the charity still getting the same amount, but you're giving them money out of your bad bucket, if you will. That's the pre-tax bucket. It's the worst bucket you can own, because every dollar that comes out is taxable. So why not give them that money? You don't pay taxes on it, and they get the same amount. Or like we do here, we call it the DAF, Donor Advised Funds, known as a DAF. Let's say you bought a stock for $10,000, it's worth $100,000. You can bundle. You can gift like $50,000, get a full deduction, right, of appreciated stock into this donor advised fund, and then you can donate that over future years, but get that main deduction maybe in a high tax bracket year or so forth. So there's so many things that you can do around planning. And I think the thing that Alina and I and our team always look at, when you look at a client's plan when they first come in, let's say a prospect that we just mentioned, they first came in, they had $5-6 million. They wanted basically a full plan. They had an advisor that was giving them good portfolio recommendations, but nothing else. And it's like, oh my gosh, you're missing the boat. And I always learned my whole life, it's if you do a lot of little things right, it adds up to major success. And so when it's the same thing with our world of planning, right? If you think of all the things we just talked about, right? Imagine what that does to the success rate and value of your financial plan and being a good steward of your financial plan when you're maximizing when to take Social Security, what buckets you pull from and why, when to do Roth conversions, or when they make sense and when they don't make sense. Does it make sense to do some donor advised funds, some QCDs, tax loss harvesting, right? Now, especially like I mentioned, when the market's down, there's a lot of accelerated planning you can do around tax loss harvesting, Roth conversions, dollar cost averaging. There's so many things you can do to make make lemonade out of lemons. Is that what they say? Yeah. Take a bad situation and make it good. Because we did this in 2020, and when everything rebounded after, the results were amazing. So I think if you're listening, we've mentioned it a couple of times, but the bottom line is, as you're listening to this, if you've saved more than $1 million for retirement, do you feel like you have just a portfolio or do you have a full plan? And hopefully during the show, you've kind of got in this episode, you've gotten an idea of the difference between the two, because a portfolio is just stocks, bonds, mutual funds, annuities. A plan is putting purpose around each account, each situation. How does it project over the long run? When I make decisions, can I buy another house? Can we travel this much per year? How do you know unless you have a plan that shows all this? And that's what we provide for our clients here at SHP Financial. And we opened the doors here back in 2003. And we have a team of over 50 here. And sometimes people say, oh, that's a big team. Well, it's because we want to have, Alina and the planning team are doing all the planning. We have a portfolio team running the portfolios and making sure those are done right. We have, 10 different teams we won't get into, but there's so much work that's being done behind the scenes that in the end result is for you, our client. So I would say if you haven't taken advantage, if you're not a client at this time, we don't take on everyone, but we do have the ability to meet. If you've saved up more than $1 million and you want a second opinion on your situation, we'd be happy to sit down with you, either at Plymouth, Woburn, Hyannis, or we have some satellite offices. But the number to call, very simple. Our office is 508-746-2400. And you can also visit us online and get a ton of information and book there as well. It's shpfinancial.com. Alina, thank you so much.
Thank you.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.